Yeah, that chart just feels like apples and oranges, doesn't it, compared those CapEx numbers. All right, let's turn our attention to precious metals and welcome in our next guest. As Marley said there, Nigam Arora, founder of the Arora Report. Nigam, always nice to speak to you. So we kind of know the story with respect to the pullback in metals today. Obviously, we have the stronger dollar and we've got limited liquidity, you could say, with the US out of action yesterday and a big Chinese holiday. They're off for a week. But can you explain the volatility attached to this trade over the last month?
Yeah, so it's starting out with a short squeeze, and you know what happens with a short squeeze. Once a short squeeze starts, it feeds on itself. And then in silver, you also have a lot of conspiracy theorists, and I won't highlight those conspiracies, but you know, you can go on X and see everywhere or Reddit or whatever. And all those people jump in, and then the technically oriented people, you know, jump in because they think it's just going to go to the moon. And then there's a FOMO, and people can't stand it, and they buy it. So we estimate that if we do the volume analysis, that the recent buyers of silver have an average price of $105. So they're all sitting on big losses. So what do? Some are margin calls, they're out. Others are trying to average down. And some still think silver is going to go to 150 or 200 or 300 or whatever the number is. So there's a lot of volatility. And then, you know, there's a lot of misinformation. For example, every day people say, oh, Shanghai silver is so much more than here in, you know, United States, so there's arbitrage. Well, not true, because in China, there's a tax that people are paying. You take the tax out, the difference is not that large, and so on. So it's driven by all kind of factors. Most of it is just misinformation.
Okay, so then what's the case for precious metals moving on to this year? I mean, everybody seems to think we're going to see a continuation. Obviously, going into this year, we're pretty much at levels now on silver that we entered 2026 on, just minus that massive spike that we'd seen in January. Just talk us through your outlook here.
Sure. So let's talk about gold first, because central banks are going to continue to buy gold, and that's the driving force behind gold. And we don't know when central banks are going to buy, but we can estimate. We think if the gold falls, you know, below about 4,400 range, we start seeing more aggressive buying by central banks. So we have a buy zone for gold, which is 38.32 to 44.68 range. And silver really follows gold in the long term. And, if you take the recent volatility out, silver is really a high beta version of gold. Longer term moves about 1.7 times gold. So silver can see spikes down. And once the gold starts seeing buying, and if silver has seen a spike down by then we'll start seeing silver. So longer term, I think they can go higher. And there's going to be an opportunity, if there are dips, to buy both gold and silver.
Mm-hmm. Speaking of opportunities and buying on dips, let's talk about what we're seeing as far as the software carnage is concerned that's really spilling over into broader tech. This is obviously to do with some of the CapEx indigestion as well. If you're going to buy high-quality leaders on pullbacks, what constitutes a major dip? I mean, is what we've seen in Amazon wiping out $450 billion worth of market cap an opportunity?
Yes. Amazon, so the way we do it, Sam, is, we have core positions, and then we add trader-on positions. We recently, on this dip, added a trader-on position on Amazon. We added a trader-on position on Microsoft. We added a trader-on position on Oracle. Our long-term positions are, from very, very low prices, because we kind of compound and also add technical positions. For example, Microsoft, we are long from like $36 and so on. We talked about silver. Silver, we are long from $13.96 and so on. The thing that's very important I want to emphasize, that when we take on long-term positions, we have a conviction, we build them kind of slowly. But when we take trader-on positions, we have tight stops and we have tight targets. So when we take on a trade on position, we're looking at, few, maybe a month or two or three or four, something like that to get in and out. So what's happening with software is, if you look at the short interest is very high, sentiment is very negative, there are a lot of these stocks are, so some of them are where there is support. Money flows are very, very negative. Ironically, when money flows are negative, that tend to lead to bottoms. And when money flows are very positive, they tend to lead to tops. So we think there's a tactical opportunity here to buy a lot of software stocks. But in the longer term, I think a lot of software is going to be trouble. A lot of these software stocks can go even lower than where they are now, even the good ones. And then the ones that are what you call are on our list to short or sell, longer term, some of them have existential threat. And those are the ones we're going to be short selling, as they bounce. So it's kind of bounce in the short term somewhere here. Longer term, you got to be very careful.
Yeah, I mean, Nigam, the markets seem to have been having a really tough time trying to decipher which companies in this sort of broad sell-off that seems to be dump stocks, ask questions later, and sell by association, type of mentality and trade here, trying to decipher between those which are immune and which are vulnerable. So how are you distinguishing between who are the perceived losers and winners in what we're seeing right now? In what has raised a lot of concerns around, whether we're seeing a misallocation of capital in a lot of these tech names.
Sam, you're so smart. You asked the best question there is. I have no trouble deciding. Let me tell you why. Because it's fairly simple. The software companies that are primarily based on workflow, meaning they're getting the data from a database and putting in some kind of graphical user interface or searching because they got some kind of search going on that's better than general search, they're going to be in trouble. Software companies that are entirely relying on the public data, they're going to be in trouble, okay? But now just look at which software companies are not going to be in trouble. As a matter of fact, after initial dip now, maybe buy, bounce, another big dip, and then, a great investment opportunity. These are the ones where the data is either private or they are data repositories themselves, or there's a regulatory issues. And the ones that are embedded in big enterprises, the cost of change is so difficult. They're a lot safer versus the ones that are focused on small to medium-sized businesses. They're going to be in trouble. So when you apply that criteria, it's pretty easy to separate out who are going to be the winners and who are going to be the losers. And so we got a list to buy and list to short.
Right, got you. Look, part of the bull case and the story that's emerging in artificial intelligence right now is coming out of Asia, particularly with some of these memory names. And of course, we've seen a lot of interest in some of these international markets like South Korea, where a lot of these tech companies are based, as, obviously investors try to wait to see where all these balls that are up in the air actually land here in the US. And so obviously it's a valuation story over in Asia right now. But is there any risk, do you think, with respect to these companies announcing a pause on their CapEx plans and seeing a sharp correction in places like Korea, where we've seen these memory stocks rallying to the moon?
Absolutely. Korea, we're long ETF EWI around 132 or whenever I looked at last. We're long from like $48. We've taken partial profits. We got our finger on the trigger for the same reason, because if there's no pause, they can keep on still running higher, right? Even the memory stocks here, like Micron, we're long from like $20. Now it's, $400. If there are no pause, they can run higher because the demand for high bandwidth memory even if there's a pause, demand for high bandwidth memory is still going to go up this year and perhaps next year. Okay. But if there's a pause, sentiment-wise, that's going to hit it because people have so high profits. So we're holding on to our core positions. We have a finger on the trigger. If they go a little bit higher, I think what we'll do is we'll do a combination of taking partial profits and hedging them. We will not entirely get out. So we've got our plan in place, finger on the trigger, ready to go.
Okay, finger on the trigger, stay nimble. Nigam Arora, always appreciate your insights. Thank you so much for the analysis today. That is the founder of the Arora Report.